Hello guys, so on popular demand we are bringing you the pension sector classes now. So let's begin with the session, and also I will be providing you alternate day sessions. One day I will be providing you pension and other day I will be providing you other subjects. As of now we are working on a Companies Act, and other than that we are starting the work on our pension sector. Okay, if you are having any kind of doubt you can definitely ask me. Also guys, if you want me to provide a lecture in Hindi as well, you can just let me know. I will do one thing, that after completing this particular part in English, I will be providing you the lecture in Hindi as well. Okay, I am trying myself my best to, so that I can provide you lectures in for both the subjects, for all the subjects actually, in both the languages. Okay, so let's begin with today's session. So status of the pension sector in India. So this is the first part in your syllabus, as you know. So first of all they are talking about introduction to pension. So what is pension to you? Of course the retirement savings, right, that we get. So of course after getting retired we do not have a active income, so that's why what do we need? We need some more income sources, because as we know, all of you know that, okay, after getting old, while we do not have a job, but our expenses keep increasing because our health is also deteriorating. So a pension is a regular income that we receive after the retirement. Okay, so if you are starting work at 25 years of age, or let us say 30 years of age, what will happen? You will start building your corpus for pension as well. So if you are earning, let us say 60,000 rupees per month, this is just an example. Okay, so what you will do? You will here make sure that you save a certain sum of amount for your monthly pension that you are going to receive in the future, or any kind of pension benefits that you want to. So accordingly what do? Rather we go with some pension schemes, and here we build our corpus. So what is happening? We are working for multiple years, right, in our life, and then what we do? We save our money so that we can use the same during our retirement and receive the pension. Okay, so why is pension so important? Of course it is providing us some financial savings, and while I am saying financial savings, so I simply mean financial safety, right? So here whenever we are getting old and we do not have any kind of regular income, it is encouraging our regular savings and helping us to build a large retirement corpus as soon as we start making this particular savings for the purpose of pension. Because if let us say that today I start making a corpus, so after 30 years I will have a huge amount of money, so I will not be worried about that how I am going to receive the income or how I am going to manage my expenses, right? Then talking about the old age income security, as I told you that financial savings are there, but also they are resulting into what? Your old age income savings, where we can see that after retirement, when the salary stops but expenses continue, a pension provides a regular monthly income that ensures the financial independence. So okay, so here you will see that pension acts an instrument of financial savings and an old age income security, but they say that for many retirement seems far away in early employment stages. So they are saying that why doesn't everybody buy a pension? Although pension sounds useful, most people don't think about retirement when they are young. Okay, suppose you are a 40 or 25 years old person, your priorities are like buying a vehicle for yourself, or buying a mobile phone, or traveling, or marriage, or house, right? So very few people will think that what will happen after I become a 30-year-old person. So here people generally don't voluntarily invest in pension. So because of this, default superannuation benefits stemming from statutory requirements are usually the primary choice for formal sector employees. So what happens in the formal sector? Here you will see that in an organized employment, for example bank, government office, IT company, public sector enterprises, or better take any large private company, employees are usually getting retirement benefits from the employer, right? So here because the employer is providing them, so this is known as a default choice, where you are not actively choosing it, but your employer automatically enrolls you. So here you will see that employers are offering pension benefits. So here these are the private companies or someone like an employer. Why will they care for us? So of course they will have some benefits, right? So here you will see that the government requires these employers to contribute towards employees' retirement retirement saving. So employer plus employee both will contribute, and mainly because of legal or statutory requirements they are making such kind of contribution. Okay, so let's talk about the current landscape. So we have organized sector and unorganized challenges. So in India, non-government organized sector, in India's non-government organized sector, provident funds provided by EPFO dominate the landscape. Now you know about EPFO. See, I will be teaching you about the EPFO in the next classes as well, but we will understand the basics here. So EPFO is what? One of the most important organization when it comes to pension. So here we have employee provident fund as well as we have employee pension scheme. So what is the purpose of employee provident fund? Can anyone tell me? See guys, here what we are doing, we are providing the retirement savings. So here employee is contributing, employer is contributing, right? If I am working, I will contribute, and also the organization in which I am working, they will also contribute. So both amounts will accumulate with interest, and after retirement the employer receives a lump sum amount. Okay, also we have here EPS. So what happens in EPS? Here you will see that in employees pension scheme, this is the pension component of EPFO, where instead of receiving a lump sum amount, eligible employees are receiving a monthly pension for themselves. Okay, so here you are receiving the amount on a monthly basis. So EPS mainly benefits the low income employees. Okay, understood? Now here you will say employers are also legally required to make co-contribution, as I told you here, to ensure the employee security. Now the vast majority of the labor force in India is unorganized sector, right? Now you will see that many workers are lacking adequate income to secure old age benefits. As a result, despite numerous mutual funds and annuities, overall pension coverage remains relatively small in India. So in India, you will see that there are three most important institutions like EPFO, insurance company and mutual fund. So in EPFO, we are being provided the pension provident fund as well as the pension scheme, right? Talking about the insurance companies, they are providing us annuity plan, and talking about this mutual fund, they provide the long term income scheme. So talking about now some insurance companies. Okay, so what they are doing, see, in insurance companies now, they have been taking a premium amount from us, and now they will be offering annuity based pension plan. Now what is annuity for you? Do you know, anyone does know that what is annuity? See, annuity simply means regular or periodic payments. Okay, there are two types of annuity due and ordinary annuity, but that is not our concern as of now. We have to understand two words as of now, that what is annuity? Regular payments. For example, let us say that you live in a rental house. Okay, so you have to provide here the rent, right? So you might be providing rent either on the first or on the last day of the month, right? So this will be known as a annuity payment. Okay, so annuity is what? You invest a lump sum, in return the insurance company pays you every month, every quarter, every year, for life or for a specified period. So at retirement, let us say there is a person, Mr. Ravi, he is saying that I have made a total investment of 40 lakh rupees. Okay, in his lifetime he has made an investment of 40 lakh rupees. Now insurance company will pay him 22,000 rupees every month. Okay, and if he needs some more amount, then also he can take the claim according to the policy chosen. Fine. And in mutual funds, what is happening? Some mutual funds are providing you long term income plans, so you invest money and later receive the regular withdrawals. So these are useful for the retirement planning. Okay, now let's talk about the stability for subscribers. So under the employees provident fund interest rate, these have been robustly retained at 8.25%. so this is the rate from, I think, years and years, so per annum for the third consecutive year. So approved by the Central Board of Trustees and ratified by the Ministry of Finance. This rate directly benefits over 7 crore subscribers. Now because of the name of the chapter, that is the status of the pension sector. See, what is pension sector, what are the different plans, what is NPS, we are going to study about them in the next few chapters or next few classes, but in this particular class we are going to majorly understand the current status. Okay, so here we have understood that in the organized sector, although the pension sector coverage is far bigger, but in India we have a large portion of unorganized labor, right, and here the situation is not very good. So talking about the current status of Indian pension sector, we also got to know that under the EPF, interest rate have been retained at 8.25% per annum for financial year 25-26 for the third consecutive year. So here Central Board of Trustees are recommending the interest rates, then Ministry of Finance is giving the final approval, and EPFO credits the interest in our bank accounts, which is of course benefiting 7 crore EPF subscribers. Understood? Now let's talk about NPS as well as Atal Pension Yojana growth. So here you will see there are more than 21 crore subscribers. So here it is a massive adoption of these schemes. So do you know that Atal Pension Yojana is only meant for people who work in the unorganized sector, right? Here you can enroll from 18 to 40 years of age. We will be covering these all in the next lectures, but I just told you the mota part. Now NPS and APY contribution. So they say that India's pension market has been growing rapidly, under which we see that combined asset under management under the NPS plus APY is 16 lakh crore plus, okay, and talking about the number of subscribers, it is more than 21 crore. So the combined assets under management, the amount that we pay them as a contribution from the employee and employer, that is here invested in different kinds of assets, right? So assets under management of the NPS and APY together have successfully surpassed an indicator of 16 lakh crore, which is of course huge. And talking about the total number of subscribers among NPS, APY and NPS Lite has crossed 21 crore as of mid 2026. Okay, so there is an unprecedented growth in the systemic coverage. Now let's talk about UPS, that is Unified Pension Scheme. So here they say that here there are some kind of biggest pension reforms that have been included in India's pension history. So UPS is operational from which date? 1st April 2025. Okay, so the Unified Pension Scheme offers a highly anticipated assured payout option for central government employees. Okay, so it is for whom? Central government employees. And why it was introduced? Because many employees wanted guaranteed pension like they had earlier the old pension system. Okay, in the very same way they wanted a guaranteed pension, not the one like they get in NPS. Okay, so they also wanted to benefit from investment returns like NPS. So the government therefore introduced UPS, and it was based on the recommendation of which committee? It was based on Somnathan recommendation, Somnathan committee recommendation. Okay, you have to remember this as well. Now they say that it is combining the features of OPS, that is old pension scheme, as well as national pension system. So here we will see that in OPS we had defined benefit and assured pension, and in NPS we have defined contribution as well as market returns. So all these features have been confined into one scheme, that is UPS. So it uniquely blends the stability of the old pension scheme. Okay, so here you will see there are defined benefit with market linked growth structure of the national pension system. Next, evolving NPS framework. So here we are talking about that how over the time NPS has brought multiple schemes framework in itself. So it was launched on 1st October 2025. What? Multiple scheme framework. Okay, so why did we bring it? See, it is known as 1st October 2025 as NPS Divas. So we said that earlier every pension fund manager offered almost similar schemes. So now we have asked these PFM, okay, to design the schemes according to the special investment themes. For example, there is one scheme that provides, let us say, 100% equity. Another provides ESG, Okay, and another scheme, let us say it focuses more on government schemes, while the fourth one, that is focused on a balanced portfolio. Fine. Now what will happen? The user will be deciding, or the subscriber will now be deciding that whichever scheme that he or she wants. So now they have a greater choice. So launched in October 2025, MSF enables the pension fund managers to introduce theme based investments including up to 100% equity exposure. It achieved an AUM of over 145 crore rupees within just 4 months of launch. Now PFRDA fee rationalization. Okay, as I told you that there are so many multiple reforms that have been provided. So here they are saying that also here PFRDA has made sure or overhauled the central record keeping agency fee structure to reduce the subscriber burden. So annual maintenance charges are now waived for dormant and zero balance APY and NPS Lite accounts. So 0% fee will be charged on which accounts? The accounts that have become inoperative, are inactive, or here have no balance. Okay, zero balance accounts are there. Now tech and regulatory advancements. So here we will see that we are also focusing on what? Using technologies. For example, AI grievance portal. So PFRDA Pension Sahayak launched in June 2026. So it is providing highly efficient AI powered multilingual grievance management. So it has multilingual features, so people from different states or regions can here basically use this particular platform and discuss things in their own languages and file their grievances. So it will help in faster complaint resolution, better transparency, 24/7 assistance, as well as improved accessibility for the subscribers. Next to regulatory sandbox. Now what is sandbox? You know very well that we are providing them a laboratory kind of environment where the regulatory compliances are lesser than the original market. So if you are bringing any kind of new product or service, or let us say new mobile application, or even for the pension sector here, what will happen? You will be provided a number of customers who will use your features, and then we will get to know if it is successful or not. If it is successful, then only we will bring it for the market. Okay, so here we are using such kind of systems as well. Fine. Next to, okay, let's first study the theory part. So here they are saying that it was notified in July 2026. So these regulations strengthen the subscriber protection when funds engage external entities for specialized schemes. So see here now, it was notified on 13th July 2026. So it is just like a testing laboratory, as I told you. So we are bringing innovation, controlled experimentation, and consumer protection. So PFRDA has also amended the exit and withdrawal regulation. Exit and withdrawal regulations. Okay, so here now PFRDA is saying that let us do one thing, let us strengthen the subscribers protection, including the situation where pension funds are engaging external entities for their specific purpose schemes. So understood. Next to digital accessibility. So the new portal supports 22 languages and voice based filing, replacing legacy system to enhance rural and senior access. Now let's talk about the global framework, understanding the standard 3-pillar structure of a pension system worldwide. See here we are provided the pension plans because of the government, right? So here we will understand them in their terms only. So they say that there are 3 pillars. What are those 3 pillars? Pillar 1, 2 and 3. See, pillar 1 is about the government pension. Okay, then we have pillar 2. Pillar 2 is about what? Your occupational pension. And pillar 3 is about what? Who would be making the contribution in pillar 3? Tell me. Of course, we ourselves, right? So, personal pension. Now, they say that for government pension, here what is happening? The government is funding it. It is non-contributory social security for poor and vulnerable people. So government is making the payment. Citizens are generally not making any kind of contribution here. But in the occupational pension, things are bit different. It is provided through employment, so contribution is done by both the employer as well as the employee. So here we are also making the contribution and our employer is also making, so it can be either mandatory or voluntarily. Fine. And then comes personal pension. So in personal pension, it is completely voluntary, where we decide that whether we want to invest, how much we want to invest, and where do we want to invest. For example, NPS, individual voluntary accounts, retirement mutual funds, annuity plans, personal retirement products. Okay, so here you will see that global pension assets under the management are how many? So in advanced economies, that is developed countries, the pension sector is substantial due to large share of formal salaried employment, while some states rely on pay-as-you-go basic pension funded assets in OECD countries exceeded on astonishing 63% of their GDP. So what are we talking about? We are talking about pay-as-you-go. So many government pensions operate on this pay as you go. So here what is happening? See, this is very easy. The government does not necessarily maintain a separate investment fund. Rather, all the current tax revenues that government is earning is used to fund the pension of people. So you are, as a citizen of the country, providing the taxes to the government. Government will consider it as a tax revenue, right? It comes under which head? Revenue receipt, and then current pension payments will be done through the same. Understood? So they are saying that OECD countries have very large pension funds, where in 2020 pension assets were equal to $34 trillion plus, equivalent to over 63% of the OECD GDP. So some countries have pension assets greater than 100% of GDP. So do you know why these OECD pension assets are so large? See, there are of course some reasons for the same. Here they have a very high formal employment, the retirement savings are also very high, and long established pension systems are working in these countries, so they have a strong financial market as well as broad participation in occupational and personal pension plans. Okay, understood? So here you will see the core concept. A pension plan is a retirement saving plan that provides a steady income stream during your retirement years, acting as a financial cushion built over your working life. Okay, next, what are the different types of pension plans? Do you know what are the different types of pension plans? See, here we have direct benefit, defined benefit plan and defined contribution. So in defined benefit, you just have to remember the OPS, old pension system. So what is a pension plan? A retirement saving arrangement that is helping a person receive income after retirement, right? So here in defined benefit, what is happening? The pension amount is already fixed. Okay, and here the amount that you are contributing as a subscriber, that is fixed. Understood? So what is happening here? In the defined benefit pension plan, the employer promises a fixed pension after retirement. So employer already knows that how much pension he or she is going to receive in the future. So suppose a government employee is retiring and the employer promises that they are going to get 45,000 rupees monthly as per their pension plan. So whether the stock market rises or falls, the employer will still receive 45,000 rupees, and this is known as your defined benefit plan. So how are we going to calculate the pension under this defined benefit plan? See, this is also very easy. First of all, we will see that how many years of service they have provided. The more the number of services, the higher will be their pension. Fine. So here we are also seeing that how much salary they were receiving. So higher their salary, the higher will be the pension amount, right? Then again we also talk about the key characteristics of DB plan. So what are the key characteristics of DB plan? Here the majorly investments are done in the government securities, the G-Secs, right? So here the pension amount is fixed, not uncertainty. Even if investment performs poorly, the promised pension is paid. employer is bearing all kind of investment risk, and that's why they are investing majorly in the government securities. Okay, so if let us say that the stock market is not performing well and they had invested majorly in the stock market, so here their stock markets will crash and employer will suffer, not the employee. Okay, and the pension is calculated using a formula where they are using the salary as well as the years of service, and here employees have a very less control. They cannot decide that how much contribution will go towards equity and how much will go towards the debt or stock markets or mutual funds. So the employer is managing the investment. Okay, so here traditional government pension, military pension, and as I told you, old pension scheme follow defined benefit plans. Understood? In the defined contribution, what is happening now? Can someone tell me? Here, who is making the contribution? Of course, we are making the contribution. So, the contribution is fixed, but the retirement pension is not guaranteed. So, employee and employer both will make a fixed contribution that will be invested, and according to the market performance, we are going to get our returns. Okay, so the retirement corpus will be completely dependent on what? The market. Okay, so pension here you will see depends upon only the corpus. Okay, understood? So, in a direct benefit plan, we saw that pension is fixed. In a DC plan, the contribution is fixed, but the pension depends upon the investment performance. So employee and or employers will contribute to an investment account. Final retirement income depends entirely on the investment performance of the chosen assets. So, direct benefit characteristics. So, what are the direct benefit characteristics? Here you will see, as I told you earlier also, they plan a guarantee specific predictable retirement income, unlike the DC. Here the employer entirely assumes the investment risk and the responsibility for funding the plan. The benefit calculation strictly follows a specific mathematical formula, that is salary into years of service, and employees have virtually no control over investment decisions, providing a passive secure retirement vehicle. Understood? Next, evaluating DB plans, what are the advantages as well as the disadvantages? So, can someone tell me about the advantages and disadvantages? See, this is also very easy, this is also not as tough. Here you will see that in the advantages, of course, as an employee, I know that how much income I am going to receive, that is the main advantage, right? So, here I do not have a lot of burden of contribution. So, there is no investment tension. Employees don't worry about the stock market, mutual fund, interest rates, and they know exactly how much they are going to receive. So, it is good for long term employees, the people who are working for 30 to 35 years in the same organization. Highly predictable and reliable income stream in retirement. The employer assumes all investment risk, relieving the employee, and here often results in higher benefit for longer term staff, right? Now, let's talk about the disadvantages. See, the less portability. Suppose you are working only for 4 years, right, and then you leave the company, so you may not receive the full pension because you have not completed the required services, right? The vesting period, that is not over. What is the vesting period? I taught you in the commerce and accountancy classes as well, that vesting simply means the minimum period of service required to earn the employer funded pension benefits. Okay, the whatever kind of benefit that we need, we have to provide a minimum number of years of service to the employer. If it is ESOP, then it will be related to that. Otherwise, if it is about our what pension plans, so it is related to the same, right? So here you will see features far less portability if you leave early. Then employers face massive investment risk and funding burdens. So what is happening? Now the employers are bearing huge risk. So investments, if they are not performing well or they are earning the low returns, what will happen? It will simply here make the employer pay the promised pension. So if they, let us say that employer's organization is not working well, then also it can be a problem to us, right? Next, funding problem. Sometimes the employer does not have enough money, so to pay the future pensions, what will happen? There will be underfunded pension plans with them. So here you will see Consequently, many modern corporations are shifting rapidly away from the DB plans to DC plans. Okay, understood? So it is becoming less popular now. Next, DC characteristics, as I told you, individually typically contribute a portion of their paycheck, often on a pre-tax basis. So here the employers are very cunning people, okay, especially in India. What they will do, they will simply calculate that, okay, how much amount is going to get in through their pocket for your pension plan. So they what they are doing, although they are contributing, but here they will make sure that the amount that they have contributed is based on your complete package. Okay, so anyways, so individually typically contribute a portion of their paycheck, often on a pre-tax basis. Okay, so as an employee. Now many organizations offer matching contribution up to a specified percentage limit. Investment choices, employees actively select their investment mix from various asset class, that is equity, debt, as well as you will see here bonds, real estate, mutual funds, right? So high probability employers are retaining absolute ownership of their account balances, easily transferring them with the changing job. So here you will see that in this particular portion, the employees contributing regularly, often directly from their salary. Now many employers are also trying to contribute the same amount as employee has contributed. And talking about the investment choice, employees may choose investments such as equity, bond, government security, mutual funds, and employer bears the investment risk here. Okay, so what you will see that, suppose the stock market is performing poorly, who will suffer? Employer, because the retirement savings may grow even more slowly. Okay, also they are providing a portability factor here. So here you will see this is a major advantage. If you change jobs, your retirement account generally moves with you. So basically, if I am just shifting from company A to company B, what is going to happen? Here you will see that I do not need to create another retirement account. Okay, I will be having the same PRAN here. Okay, that we are going to study in the further classes about the PRAN and everything. Now let's move towards the advantages and disadvantages of this particular DC plan. So here you will see that in India we have NPS, EPFO, accumulation phase is the contribution based, right? Then Atal pension Yojana, and also at international level we have few retirement accounts. Fine. So what are the advantages? See, here you can easily change your job, right? It is providing you excellent portability between the different employers. Now even from one country to another you can change your job, not only just from one company in the same country to another company. So this account usually remains yours even if you switch the employers. Now talking about the employee control, you decide that where you want to invest the amount. Okay, how much investment must go towards one type of equity or in the debt scheme, right? So here you are getting the authority, or you are getting the control for asset allocation and risk that you want to take. Also talking about the tax benefits, so in India we are provided tax benefits on the retirement saving under the old tax right scheme. Now employees can often increase or decrease their contribution subject to the scheme rules. Fine. So here we are having the total control over their our investment decisions, high flexibility in contribution amount, and powerful tax advantages. But of course, with advantages comes some disadvantages. So what are the disadvantages? Market risk. Returns are uncertain. Pension is not guaranteed. Nobody can promise that you are going to get 40,000 rupees or 50,000 rupees every month. Everything will be dependent upon your retirement corpus. Okay, so here is some market risk. Market risk meaning the prices of the investment, for example the stock, changes in an unfavorable manner that provides you loss, right? So this will be known as the market risk. The ultimate retirement income is uncertain, and the responsibility for saving adequately rests solely on the individual. Here you will see that if you save very little, you will receive a small pension only. Understood? Now phases of a DC plan. So there are few phases in a DC plan. So what are those phases? See, we are talking about, first of all, what? We are talking about the defined contribution plan that has a few phases, like for working years, that is working just like you are filling the tank, and retirement, that you are using the water, right? So here you will see that in the accumulation phase, that is the period before your retirement, where you are saving and investing the amount, right? So here in the accumulation phase, you are saving and investing the amount. So this phase will usually start when a person begins working and continues till the time they are investing the amount from their salary or their retirement. Okay, so we are building a retirement corpus here. So here you will see that you are getting a salary, there will be some monthly contribution from your end, which will be treated as the investment. You will get some returns and your retirement corpus will keep growing. Fine. So here by retirement, you will see a large corpus into the power of compounding goes, and you earn a lot of money. For example, let us say there is a person who has joined a company at an age of 25. Now employee is contributing 5k, employer is also contributing 5k. What will happen? 10,000 rupees will be contributed in a month. So in 35 years of his working age, meaning 35 years after he has worked for 35 years, okay, he will receive a lot of amount, okay, based on some compound interest. So the active working years focused on a regular contribution from both employee and employer. Key activities include making strategic investment choices, balancing portfolio diversification, continuous monitoring to grow the balance. Decumulation phase. Now what is decumulation phase? See, in the activities during the accumulation phase, we focus on regular contribution. The contributions are invested in different assets, for example, equity, government security, corporate bond, mutual fund, to earn returns and grow the retirement saving. And here in investment choices in many DC plans such as NPS, you will see that employees can choose where they want to invest. Okay, suppose there are two people, Neha and Raj. Now Neha is 28 years and comfortable taking higher risk, so she may choose 75% investment in equity and 25% in debt, because here in debt we get less interest to fine. But here let us talk about Raj, who is 55 years old, so he may choose 20% investment in equity and remaining 80% in debt. So it is depending upon the contributor that where they want to invest, and it will depend upon investment allocation will depend upon risk tolerance, their age and retirement goals. Okay, now diversification is there, so you are not putting all your eggs into the same basket, rather you are putting all your money into different types of investment. Let us say equity, government bond, corporate bond, real estate investments, right? There are REITs and InvITs these days, and you can simply regularly monitor the same, what are the market changes, risk appetite and retirement approach. Next comes decumulation phase. So what is decumulation phase? Now this is the phase that starts after your retirement. Okay, the post retirement phase, where you are going to use the accumulated corpus to meet your living expenses. So you are converting your savings now into a regular income. So what is happening here? You will see that we are focusing on some important decisions during decumulation. For example, what will be my withdrawal strategy? Okay, what should be my now withdrawal strategy? So here you will see that how much should you withdraw every year. If you withdraw too much, the corpus may run out early. If you withdraw too little, you may not enjoy your retirement adequately. So here the corpus is, let us say, for 1 crore rupees. Either you will withdraw 15 lakh every year, or corpus may be exhausted quickly, or you will withdraw 5 lakh rupees every year and corpus lasts much longer. So the aim is to make the withdrawals sustainable. Then we have to also focus on what? Income generation methods, right? So here you will see that there are 3 common ways to receive the retirement income. One is systematic withdrawal. Wait, let me check. Okay, we are going to study this in the next few classes as well. Just I will give you an example. So one is your systematic withdrawal, where you are withdrawing a fixed amount regularly from your retirement corpus. For example, the corpus is for 2 crore rupees. You are each month withdrawing, let us say, 60,000 rupees from the 2 crore rupees of corpus. That is your monthly withdrawal, right? Next, annuitization, that you use a part of the retirement corpus to buy an annuity from an insurance company, that you are going to study in the next classes, where you are, what you are doing here, you will be taking, let us say you have a corpus of 1 crore rupees. Now you purchased an annuity. Okay, so what is happening in this particular annuity? The insurance company will say that okay, I am going to pay you 55,000 rupees every month. Fine, understood. And there is also a combination strategy that you are having a corpus of 2 crore rupees. 1 crore will be used to buy an annuity and 1 crore will be used to keep invested and withdraw the amount systematically. So this is going to balance the guaranteed income with the flexibility. Okay, so it involves establishing a safe withdrawal strategy, potentially purchasing annuities for the guaranteed income, and managing risk to prevent the depleting corpus. If you are not able to understand the decumulation phase, don't worry about it. We are going to study in further classes in detail. Okay. Now, EPFO. Let's talk about Employee Provident Fund Organization. So it is a statutory body, meaning it was established under an act by the Ministry of Labour and Employment under Government of India. So it administers the retirement and social security benefit for eligible employees. So what does a statutory body mean? You know very well that it is created through an act of parliament, right, and has legal powers assigned by the law. So here you will see that there are few main functions of EPFO. So it administers the EPF, EPS and EDLI, providing critical social security schemes for millions of employees across India. So we are managing EPF here. It is collecting contribution from employers, employees, invest the fund, credits the interest and it also pays the retirement benefits. So also it is administrating the EPS, employee pension scheme. So we are providing monthly pension to the eligible employees. Along with that, now we are moving towards the EDLI, that is Employees Deposit Linked Insurance, where we are providing insurance protection to the employees covered under EPFO. So if an eligible member dies while in service, the nominee receives insurance benefit as per the scheme rules. And under the social security benefits, EPFO will be providing you provident fund, insurance, pension, partial withdrawals in eligible cases. Okay. So here you will see there are key features and benefits of EPF, that is contributory and tax benefits. So here both employer and employees will be making the contribution, right, and these contributions along with the generated interest are generally tax deductible and tax beneficial under specific condition. So here you are going for a primarily long term savings for your retirement planning, and here you will see that under the Income Tax Act there are few tax deductible savings. Okay, so you are able to even save your taxes, and there are social securities provided through the retirement corpus, pension and EDLI, that is insurance scheme. Now what are the benefits? See here you will see it acts as a powerful mechanism for long term saving. Substantial retirement corpus is being provided here. It acts as a robust social security net, providing during unexpected job loss, severe disability or death. So EPFO current status. What is the current status? As of now you have understood that we are being provided 8.25% of interest per annum from the last 3 financial years, and here it is benefiting 7 crore plus members. Talking about the EPFO corpus, as of now we have assets under management 28.34 lakh crore as of March 2025. These funds are securely and predominantly invested in government securities, state development loan, PSU bond and selected equity ETF to optimize the returns. Okay, now talking about the major operational reform, here you will see the Central Pension Payment System, that is CPPS. It has been rolled out all over the India. So pensioners can receive their pension through any bank branch across India. Okay, now you can receive the pension from any bank branch. So here the convenience and portability has been improved. There is a facial authentication as well. Okay, So we call it as a facial authentication technology, where digital life certificates can be submitted using face authentication. So we are reducing the need for physical visits. Then there are reforms in EPS as well. So we have revolutionized the updates, so allowing withdrawal benefit even after single month of contribution. So here the amended schemes provisions are there, and in the EDLI enhancement, insurance benefits are ranging from 2.5 lakh rupees to 7 lakh rupees. And talking about the auto claim settlement, EPFO has settled 2.16 crore auto claims in financial year 24-25, which reflects the significant improvement in automation and service delivery. So talking about the grievance redressal, during the period reviewed by the 239 CBD meeting, 17.33 lakh grievances were resolved, okay, and 39.74 lakh calls were attended, okay. Now we are focusing on EPFO 3.0 and everything we will be covering. So this was just like an introductory lecture. I hope you like the lecture, and you can simply like it, hype it, talk about us to your friends who are preparing for the similar exams. So if you have not subscribed the channel, do subscribe the channel. You can get ebooks related to your PFRDA preparation on our website, that is rpacademy.co.in, or you can even download our application, that is RPA Academy. Okay, that's it for the day. If you are having any kind of doubt or feedback, you can provide us the same. Also do let me know if you want the lecture to be bilingual as well, or you can simply study from these English lectures. Okay, you can just let me know. Thank you so much for the day, and bye bye guys, take care.